Greetings and welcome to the Principles of Accounting course by StudySpace. In this chapter, we will be studying about accounts receivable and how to account for them in more detail, as well as a different type of expenses that can be incurred against account receivable. So account receivable is basically when someone owes you. There are three distinctive types of account receivables. Firstly, the normal account receivable. Then we have our note receivables. And lastly, other receivables. Now, account receivables are accounted for like the normal any entry, as we studied that when we have an account receivable entry, it would be that account receivable debit and whatever that we got against it, for example revenue, credit. And once we were paid, it would become cash debit and account receivable credit. But what if an account receivable did not pay up to a certain point in time? Then we would convert that account receivable into a note receivable. Now, in the case of a note receivable, the entry becomes a little more different. So, say in the case of a note receivable, we had an account receivable who did not pay us for a year, and therefore we then turned it into a note receivable. A note receivable is a more formal contract wherein a certain interest is also charged against the account receivable. So the entry of a note payable would be that of an interest entry, which would be first we would remove the account receivable that was before this. So for example, say that someone owed us $5,000. So note receivable would debit by 5,000 and account receivable credit by 5,000. Now say a certain interest of 10% per annum was charged. So an interest of 10% annum would mean that 500 interest would be paid. So when we were paid back this note, the entry that we would make would be cash debit by 5,500, note receivable credit, and interest revenue credit. So that would be the entry of a note receivable. Now moving forward, we will look at the expenses that are incurred along with an account receivable. Now we're going to look at the expenses. So with the case of an account receivable, there is always a risk that you may not receive your money back. This risk is defined in prudence in such a way that we state this expense as allowance for doubtful debts. This allowance is set aside for a percentage of the accounts receivable in such a manner that if these account receivables are not paid back, then we have a certain cash resource set aside to cover them. This allowance for doubtful debt is made in two ways. Firstly, percentage of the total, or secondly, based on individual properties. So a percentage of the total would mean, for example, if we have a total debt of say 10,000, and we decide that a percentage for our bad debt would be say 10%. So a 10% of this would be 1,000, right? So we would set this aside by making an entry such that bad debt expense debit and allowance for doubtful debt credit. Now, in the form of a T account, the way we account for such doubtful debts is that there is a balance that is brought down from the previous term, and there is a balance that is to be continued. The balance that is brought down, say, was 900, and the balance that is to be continued is, say, 1000. This is our allowance for doubtful debt account, and this is a rough draft. This is not exactly completely up to clear format, but we've studied the clear format in previous videos, so you can refer to that for a proper format of a T account. So now the difference between the two, that balancing difference will become our bad debt expense, which will be charged here and recorded into the income statement with such an entry that we have done here. So now moving forward, we will look at the second, which is based on individual properties. Now sometimes the case occurs that some debts are greater than other debts. So for example, say you have a debt that you incurred 90 days ago, then you have a debt that you incurred 50 days ago, then 40, then 25, then 15, then 10, then 5, then 2, then 1. So what accountants do is basically they take the distance or the duration of the debt, and based on that they apply a certain percentage to it in order to derive the amount of bad debt expense. So for example, in the case of 90 we charge 50%, in the case of 50% we charge 25%, in the case of 40% we charge 15%, in the case of 25% we charge 5%, in the case of 15% we charge 2%, in the case of 10% it's 1%, in the case of 5 we charge 0.5, because there's as we go down the spectrum there's a lower and lower chance of the debt being bad debt, till finally we come to this conclusion. This gives us the days of bad debt, and this gives us the percentage that we have to apply to receive the bad debt. Now we're going to write down the amount by which the percentage needs to be applied for us to calculate the bad debt. So this amount shall be any random number, for example 1000, 10,000, 2500, 24,000, 52,000, 9600, 82,000, 2,700, and lastly 100. Right, so we will multiply the percentage by the amount to get the amount of bad debt that would be incurred, and then we would total it up to calculate the amount of bad debt that we have incurred in this particular year. So that is the particular expense that is incurred along with account receivables, and that is going to be it for this chapter. You can do more example questions in the book for more clarity, as there are a great many example questions that we can't cover in these videos. So I have given you a certain example overview of how you can calculate this, but I recommend that you try questions from the book. And that's it for this video. Thank you for your time.